From the morning reading, consumers are just as apathetic as investors. The two groups are not mutually exclusive, but economic surveys typically cover a different, longer term group than investment specific surveys. The latest economic survey from the Conference Board showed that more consumers still expect stocks to decline over the next year than expect stocks to rise, despite the S&P 500 ending the month near the all-time high. Shorter-term options traders are backing off protective puts. The 5-day average of the equity put call ratio has declined to its lowest level in more than a year. While other option indicators aren't confirming a bout of excessive optimism, when the 5-day average of the ratio drops to a yearly low, stocks have struggled up to a month later. There is now $4 invested in stocks for every $1 parked in safe money market funds. The latest figures from the Investment Company Institute show that investors have moved back into stocks, but not to the degree seen at the peak in 2015 when the ratio reached 4.5 to 1. Even a ratio of 4 to 1 is higher than what was seen at the prior market peaks in 2000 and 2007, which is at least a modest long-term worry. Hello, this is Stephen Harris, a head trader from Falcon Global, where we model best practices for investors, traders, and day traders from entry to exit every trading day. In this daily video, I provide my opinion and insights of current market trends, market timing, volatility, and hedge risk levels for the upcoming day for the key U.S. financial markets. It is 6:05 a.m. Mountain Time, and I am recording this in preparation for the market day of June the 1st, 2016. Full disclaimers are at the end of the video, but be aware that this is for educational purposes only, and only you are responsible for the investing and trading decisions that you make. Well, I'm happily ensconced in my new trading desk office in the Rockies, the northern Rockies of Montana, and very happy to have everything all put back together. It seems like it's been forever since I've had the ability to work from my normal platforms and software and everything, and with all the chaos of the move and so forth. But things are definitely settling in, and we got everything up and running, and we're at our normal trading platform today. So hopefully we'll start to see some of the activity and so forth around the published reports and all start to become more normal. In the meantime, that would include these market previews. We've missed a number of these market previews of late, and I would hope that they would start becoming to their normal every morning schedule. That being said, I may produce some of these in the evening before, and if you haven't subscribed to the YouTube channel, you really ought to. Now that I've gone to Mountain Time Zone, I expect that I'm going to use some of the opportunities of these long evenings. It doesn't get dark this time of year around here until 10 o'clock at night, and I might do some of these videos in the evenings, and on the flip side, my mornings are shorter, and the market opens at 7:30 Mountain Time, so I have less time in the morning to get all this stuff put together and more time in the evening. So you may see some differential in terms of when this is published, but if you're a subscriber to the YouTube channel, you get notice when I actually publish the content. That allows you to jump on it whenever that happens. So something to kind of keep in mind. You just go to the little subscribe button you see here. Once you get to that web link, that's our regular Falcon Global Traders channel on YouTube, and you subscribe to that channel. That's free, and that allows you to get that notice. Also, when you are at that site, there's some gears. There's a little gear button there, and you want to make sure that you watch this in high def resolution. Makes the charts and so forth look much sharper. And then finally, the last thing I would mention is that if you've not been using the video playback speed button controller, you should find that. That allows you to speed this thing up. And most people probably listen at about 1.5x and find that they can follow everything quite well, and yet cut down the time in which it takes to get all this information that I convey to you each morning, and a little less total time. So a couple things to think about there. Let's go ahead and dive in and to our morning report. And thus far today, it's a little bit of weakness, but nothing to get too excited about. All four broad market U.S. indices are down. The S&P futures are down about 1/3%. The Russell futures are down about 1/4%, as are the NASDAQ futures. Dow futures are down about 1/3%. Crude oil is down about 1.3%. Euro is up about 1/3%. Bonds are up just above scratch, and gold is up about 1/4%. China down just below scratch. Hong Kong down about 1/4%. Japan down much larger, about 1.6%. Germany down about 2/3%. And United Kingdom down about 3/4%. In terms of macroeconomic reports of note for today in the United States, you see we have an enormous list, but for the U.S., it's ISM Manufacturing PMI, and that is during market hours, so be aware of that one. That could pop you. And the rest of those are all yellow, so not expected to have significant impact. And looking ahead to tomorrow, a little crunched up because there's so many in the next 2 days. We do have ADP non-farm employment change, the weekly unemployment claims, FOMC member Powell speaking, nat gas storage, and crude oil inventories. Note that the crude oil inventories has shifted this week, and that's because of the Memorial Day holiday. So crude oil inventory report comes out on Thursday this week. Let's go ahead and go to market conditions, and this is where we look at current volatility conditions, and you notice that the 5-day versus the 10-day has been increasing, though overall these are relatively low levels of volatility. Short-term VIX is only 11.85. Skew is in the caution warning status up above 125, so keep a note on that, especially if you see that start to climb to up over 135. Current IV percentiles for the different markets: the S&P a very low 10, the Russell a 15, the NASDAQ an 8, a Dow at a 7. We did have a standard deviation move put in by one of the indices yesterday, and that was the Dow, and it was down a standard deviation move. The others less than a standard deviation move. Relatively calm in the last 2 trading weeks. You see, we normally see about 4 days or sessions with a standard deviation size move, and right now on the S&P we have 3, and none of those have been in the last 3 trading sessions, so pretty calm there at this point. In terms of, let's go ahead and go to the daily report. We'll scratch that. Let's go ahead and go to the charts, and you see here we have the S&P futures charts up. And look at this, you know, these have been drawn here for some time, this area of expected resistance, and this most recent price action has just run right up to that area and then turned. This continues to be a significant area for us to have to fight through, and the question is going to remain, the primary question is, can we get through that and actually break out and achieve something? We've had these tremendous bullish moves in recent weeks that have, you know, come at every time the bears look like they were really starting to achieve something. The bulls have come in and rescued this, and we had this historic move from mid-February into the, you know, really the beginning of May. And I thought it kind of ironic we had these most recent highs just in the days before the Memorial Day holiday. Well, the all-time highs are last year in that week just before the Memorial Day holiday, and then we started selling off as soon as we came back from that holiday. Well, we've repeated that pattern this year, and from a little lower level, we're not at all-time highs, but bottom line is we continue to see that this time of year seems to struggle up against these levels. So we've not achieved anything in terms of the bulls being able to truly bank any real profits from last year's Memorial Day weekend, and here we are a year later, and we have bumped up against this resistance area repeatedly, and failure after failure. So this still is the primary storyline, though. Where are we likely to go right now? If we don't break through that area, we're likely to stay in a more sideways pattern. And as you see here, until we break below this 2025 or break above this 2105 area and really break through this whole area about 2134, that's the area of resistance, we're not likely to see any significant movement to one side or the other. Now, bulls and bears, if they find some energy, those are the trigger points that we are watching to see if something larger can develop. Anything in between those two areas, which is, we'll call it 100 points, anything between that area is nothing more than sideways churn, and nobody really has an upper hand. You see the cloud has been coming up and pressing with this most recent action, and this could also form as a bit of a basis of support. Key moving averages are all below us as well. So there's a lot of support. You have to give that to the bulls, and they continue to come in and rescue. And yet at the same time, you got to give it to the bears that they are not allowing the bulls to actually achieve anything of note. Let's go ahead and go to the Dow. And the Dow, very much the same picture. These have been in very, very tight correlation in recent weeks. NASDAQ coming into a lower swing high right now. We'll see if this actually sets itself. But NASDAQ has not been the leader that it needs to be able to drive the broad market to all-time highs. And then, of course, the Russell also very interesting, right up against this swing high area at this point, and starting to consolidate. We'll see if they can gather some energy and go somewhere. So all these, it's a really, really difficult time to initiate new bullish positions, especially highly directional trades, because you're right up against a significant area of resistance across these indices. Very, very tough sledding for those new positions. In terms of taking on bearish positions at the same time, you have to give respect to what's going on in the big picture. And we'll get to the daily report in just a minute, but those reports have really firmed up in recent trading sessions, and this is a very different picture than it was a few weeks ago when, heck, we hit hedge risk level 2 there for a little while. That condition is no longer present. Gold has severely broken down, and while it's found some support here of late, basically off this area of this prior swing low, this is a very, very messy pattern. It looked great through here, then formed the triangle, broke out, but then that pattern then failed. It wasn't just a bull flag or even a more complicated consolidation, but it broke down and made lower lows, broke down through the cloud, and has really come down all the way to the swing low of this entire pattern. So gold is very much in question at this point as to whether the bulls really are in control and whether this may reverse itself. If it does reverse itself and break through this area, you could see it swing back all the way to the December lows. So at that point, it would actually be a bearish trade instead of gold being in a bullish posture. In terms of volatility conditions, you see we continue to be very low. In fact, on the regular VIX, we're playing right around the 13 area. So as low as we've been in months. That may in itself present some opportunities. And then finally, let's take a look at bonds and see what bonds are telling us. Bonds also in a bit of a sideways pattern. You see it looks to be in something of a triangle pattern. And we'll see if we start to come into this apex, if this starts to break. Right now, the expectation is that it would break to the bull side, which would be a downer for equities likely, but that has not yet happened. So right now this is just in a sideways pattern, much like the equity markets are in a sideways pattern. Let's go ahead and go to the daily report. We got a lot of changes here that have come of late. First of all, I want to note that the market trend intermediate term phase opinion has left that phase 5, which was a bearish phase, and has now gone to phase 2, which is a trend reversal phase. So this is supportive of the bull case. From the 3 market timing signals, you have confirmed uptrend. You have from IBD, and also in the second signal, in the GMI index, you have a perfect 6 out of 6, and that buy signal has been in place now since 525. And then going to our third mechanical signal, the stock charts decision point scoreboard. Look at this. I really would not have expected this a couple, 3 weeks ago, but we're starting to see the stack form, and that is where our short term, intermediate term, and long term are all in agreement. We're not quite there yet, but with the rash of new signals that have come in recent trading sessions, have really firmed up the short and intermediate term. We've only got one short-term signal left, and that is on the Dow. And then we've got all bullish intermediate term signals. The long term is still quite mixed and on all the indices here. So not quite the stack that we like to look for, which is often evident during trending markets. And we talk about, achieving anything. Well, if we see this stack along with all these other signals, in buy mode, we'll likely start to see the bulls actually start to achieve something. So not there yet, but getting very, very close. In terms of position sizing opinions, we're at 100% on the portfolio investor position sizing opinion, and then the other mechanical position sizing opinion model based on volatility is at 75 to 100%. So that's also supportive. Intermediate term market posture is now supportive as well, and with the S&P being a strong bull. Also notice that the Dow is also strong bull, and the NASDAQ and Russell are up over 80 now, so they're in the severely strong phase. So they're all very, very supportive of these mechanical signals. And do note, we do have a weak bear sentiment line. This is a more long-term signal, so that is a bit of a counter headwind against these intermediate term market posture numbers. So kind of keep that in mind. And it could be, again, telling us that the bulls are having a hard time actually achieving anything. In terms of the strength of the trend, we are currently in a very strong bullish trend. In terms of the hedge warning status, we have dropped down to level 1, which is caution light. So there are still some warning signs in the market. We're not at normal levels quite yet, but we've come down quite a bit from the level 2 and 1 plus that we've had in some recent trading sessions. In terms of special opinions, option income strategies, the VIX is acceptable. It's inside the acceptable window, so to initiate new positions for even novice traders would seem to be quite appropriate. In terms of covered calls, conditions also acceptable to initiate new positions. Consider a 1-to-1 ratio of in the money and out of the money strikes, especially given the fact that we are up against significant resistance in the broad market indices. So a bit of defensiveness mixed in, and using another way to get some defensiveness is a mix of low beta and high beta positions. A 1-to-1 ratio is the opinion there as well. So you want to have some bullish exposure when you have all these mechanical signals in the bull mode, and yet at the same time you want to be aware of where we are against that significant resistance, and don't get ahead of the market. The market is definitely firmed up and improved, but it is not an all clear signal quite yet. It's certainly very much improved. Put selling also acceptable, and very much so in this point. We are still level 1, so consider perhaps reduced position size, well out of the money puts for both your conservative and aggressive setups. In terms of specific warnings, we have the volatility warning ratio warning fired with yesterday's session, so that would point to the potential in the short term of increasing volatility, which usually means a pullback for the market. So watch for that. We also still have the VIX in a daily squeeze. It's been in a daily squeeze for weeks now. So at some point that will exit and volatility could expand quickly when that happens. Not yet signaling that it's going to happen, but that's always a possibility. The distribution day count is still in warning status, though this has been dropping. It is now at a 6 on both the NASDAQ and the S&P. If it drops below 5, that will go off warning status. Skew, we mentioned this earlier, it is currently in a low-grade warning status. Other things are strongly bullish. Notice the New York Stock Exchange, new high, new low, 428 yesterday on the new highs. Key intermarket risk aversion indicators all in the risk on position. From a sentiment standpoint, short-term risk for stocks is somewhat elevated. And you see in the fear and greed index, we're now in the upper quartile. So some sentiment readings are starting to come in as somewhat excessive. Now that itself is not a strong signal for reversal, but it does tell us to start to watch for those signs of reversal patterns. In terms of sector specific, note the short to intermediate, even into the long term, pretty much a sea of green here with only a couple exceptions, consumer staples and retail. Though on retail, I would have to point out that this was strongly down, down, and down, and has been significantly improving in recent sessions. Percent change from yesterday, you notice the utilities, telecom, and then into healthcare were the ones that were positive yesterday. Though the week, all the sectors were positive. Bit of a mixed picture between the 1 day, the 1 month, etc. And this is what you get when you get in these sideways markets. Right now, we're near the top of this sideways range, so most of this is green. But the real sign is, can we actually achieve anything? And I think that's probably enough for today. We've gone over 20 minutes. It's been a few days since we've published, so I wanted to really dig into some of this material, especially all these changes. But let's go ahead and wrap this up for today. I'm going to scroll through the closing sequence. If you see something of interest, just hit the pause button, go to that hyperlink, get the additional details that you're looking for. As always, though, I do have to mention the disclaimers. We are an educational service and have no fiduciary responsibility to your financial situation. Hit the pause button if you need more time with the disclaimers. Also, note the full disclosure may be found here at the bottom. Go to this hyperlink at the bottom. That'll take you to the full set of disclosures. In the meantime, we'll see you back here tomorrow morning with the market preview from Falcon Global, and good trading to all of you.